This is such a Pradyuman of Cirrus Research. We've just launched the AI Downstream Indices here at Cirrus. The industry outlier just out looks at the fundamentals between the upstream and the downstream plays. Upstream is effectively the AI chips, effectively NVIDIA, plus the other few players. What we make a case, and we've made this case in the last few months, that the spending on AI is now about to become much more diffused. And as a result, it opens up a lot more opportunities. I think in the last few years, what we've had was much more of a very speculative world where investors were not really sure what was to come of AI. So the idea was to basically speculate. In other words, own the picks and shovels of this thing called AI. A couple of years later, what we're beginning to realize is that short of finding, let's say, the sentient man, this technology, it looks as if it is going to be embedded. It's already begun to be embedded in all these various industries. So it's much more context-based, and it's a mixture of large language models plus algorithms. So moral of the story is that we do believe the downstream spending is likely to accelerate. I think it's already underway. The title, as I said, Cirrus launches AI Downstream Indices as AI spending to broaden. This chart is very surprising. In this year of volatility, what we're seeing is the upstream bin, this is through May, the semis, these are AI chip dominant semis, it's down 6% even with the rallies we've seen. Whereas some of the downstream players, such as the data centers, the realization that the demand for energy is only going to accelerate. Cybersecurity, with these new large language models, the complexity of security on networks just became much more complex. So moral story is that we do see these spending levels accelerating. You can go through all the sort of industry experts, and these articles are all projecting very robust growth over the next bunch of years. But the bottom line is when we look at these areas from big data, data centers, nuclear, the sort of application side where, effectively, if you spend billions on these chips, then you've got to monetize it. So the software applications that are going to be released, we're already starting to see very, very bits and pieces of this that's already helpful to real industry. So if we look a little further, this report really centered on three main areas. One was data centers, nuclear, and cybersecurity. Of the groups, we thought these were interesting to focus on. Across the board, these growth rates are all accelerating. And in fact, I would argue that the growth rates we've pulled together here is a little bit more conservative. If you were to look at explicitly AI spending within each of these verticals, the numbers will be a lot more dramatic. So moral of the story is that we do see an acceleration in spending. Some of these companies are old economy companies, so we think there's a lot of room here for multiple expansion. Importantly, when you look at, let's say, NVIDIA, what's also important is this is a $3.5 trillion company. So how does it continue to accelerate growth, especially when the top line growth has begun to decelerate? Still a fantastic company. So moral of the story is that growth managers, investors for high tech are going to be looking in addition to NVIDIA. And so we think that's the opportunity here. Importantly, the forward estimates we think are benign. They have started to pick back up. I think some of this damage occurred earlier in the year with DeepSeek and also the tariff wars. However, I think if we start to continue to move through that and stabilize, the forward estimates are going to accelerate. So the opportunity here is that the estimates for the forward year can only, I think, pick up. Importantly, we talked a little bit about NVIDIA being 3.5 trillion and how the spending in the last few years has been very, very upstream. What this multiple, the technology multiple chart here relates is exactly that. The market is very concentrated. We think there is room for rotation. And fundamentally, if the spending is going to become more diffused, the smaller tech multiples are now at massive discounts. In fact, large tech stocks are more than two standard deviations above normal, the smaller tech multiples. And this is data going back 30 years. Take a look at the report. And as always, happy to take your questions. Thank you.